Hello, 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 and happy Thursday. Welcome back to yet another live event where we unpack passive investing in apartments and multifamily underwriting one step at a time, one live event at a time. So, assume at your own risk the loan terms you cannot ignore is a topic I will briefly cover today based on popular demand. But before we begin, my name is Vessi Kapulian. I'm a former commercial lender turned real estate investor, and today I help busy professionals in two ways. One, I help connect them with well vetted cash flowing investments in apartments. And for those willing to learn how to vet apartment deals, I help them learn how to underwrite from beginning to end so they can evaluate these deals with confidence and ease. I also help do a one-off second set of eye deal reviews, helping investors navigate through the complexities of the deal structure, key risks, and so forth so they can protect their capital. Now I'm changing the timing of the pop-ups a little bit due to some travel schedule, which I'll why would looks like the connection paused for a moment. So why would someone even consider a loan assumption? Well, in a rate environment like today's, when rates are on the higher end of the spectrum relative to where they were maybe a couple of years ago, right, which is at the bottom of the market, it may be attractive to be able to take on or assume a loan with a lower interest rate, which would then in turn create more cash flow relief. And especially if that rate is fixed and risk mitigated, resolves a lot of concerns around interest rate fluctuations. But it's not as simple as it sounds, at least on paper, because there are a few key considerations to keep in mind. First of all, when as an operator or a buyer, right, you're assuming someone else's loan, what you have to consider is that seller's other large partner, which is the lender, right? The lender is typically the largest partner in your deal. And even though the existing loan agreement may allow for the option to assume the loan, it doesn't mean that they're obligated in any way to approve the assumption. In order for the lender to approve the assumption, ultimately they will need to be comfortable with the counterparty risk. And again, think about it, right? They may be better off placing a brand new loan at a higher spread and higher interest rate loan environment versus approving the assumption of a 3 or 4% loan. So today, now more than ever, they would be scrutinizing the counterparty to ensure that the risk remains as low as possible. And what do I mean by counterparty? Effectively, they will be evaluating you, the person assuming or taking over the loan. They would want to do a deep dive in on your personal balance sheet and income statements, effectively your personal financial statements. They'll dig into your track record, the track record of your team, to effectively gain comfort that you will continue to, especially in the case when the property has been operated well and performing well, that you'll continue to do so in order to protect the cash flow and effectively ensure that you take good care of the collateral and gradually pay off the loan. Another factor, apart from considering the counterparty risk for you to keep in mind, is yes, in today's environment, more likely than not, the loan that you will be assuming will have a lower rate. I've seen in some cases 3.18, I think is the lowest I've seen, sometimes 4%. I think 5 is like the highest I've seen. So in other words, a rate that it's much better than what you would otherwise obtain today, and likely with decent leverage, right? 60%, maybe 70 at most, especially if you take on a supplemental, but no more than that. So on paper, everything seems attractive. Maybe you're buying the property at a 6 cap, so you're getting positive leverage. That's all good. But it does not necessarily mean that you should overpay for the property. Now, the lower interest rate loan is definitely an asset, especially in today's environment. So you may be able to pay a little bit more for the privilege of having that, but it doesn't mean you should overpay. Another, I don't want to say mistake, but maybe a red flag is how I would describe it, that I see often investors do. They all talk about cap rate expansion, and it's all great, but they're taking the expansion from the point of the acquisition cap rate. And especially in a situation where they're maybe assuming let's just say a 4% loan and buying the property at a 4.5 or 5% cap rate, I would argue they may still be overpaying, especially if the market cap rate for that particular property and location is maybe closer to the, say, 5.5 range or 6 range. And so the miss that I often see, or maybe the red flag, at least from my perspective, is when modeling the exit, they're starting off with that lower purchase price cap rate, which maybe say 4.5 or maybe 5%, and increasing it from there. Instead, I would always, personally, at least for me, based on my risk tolerance, I would want to see the cap rate expansion start from the current market point, not from necessarily the purchase price, because again, you may be acquiring the property at a very deep discount, right? So that doesn't necessarily mean you should be uh, taking that into your exit. Instead, always start off with the market point. So if you're buying at a 4.5 or let's just say 5 cap, because you're assuming a 4.5 rate, and the market is maybe 5.5 to 6, start the expansion from that 5.5 to 6 point. I also want to understand really well what the existing loan terms are, ensure that they align with your business plan. And in some cases, for example, the seller may have, let's just say, 3, maybe 4 years left on the loan. And if you have a 5 to 7 year business plan, then there are a couple of things to consider when you think about the exit. You either need to sell in 3 to 4 years because that's when the loan matures, or consider a refinance situations, which is where, again, conservative and very careful exit planning is very important, because at the time of, say, refinance, if you decide to hold and not sell the property, the loan terms you will be getting are likely very different from the loan terms that you're assuming, especially when it comes to loan to values and all-in interest rate and such. Of course, nobody knows where the market will be 5 years from now or 3 years from now, so let alone a year from now, really. But for that reason, it's important to plan conservatively. And so that's what I wanted to share with you, the counterparty risk, not overpaying just because you're getting a loan assumption, really considering the exit cap rate or forecasting the exit cap rate accordingly, and last but not least, planning the exit very carefully. In today's environment, right, when rates are high, you, especially as an operator, right, if your loan is assumable, a couple of years from now, if you decide to exit early, for example, and if the interest rate environment is different, meaning if rates are lower, then in that case, you may be facing a situation where you don't want to incur the prepayment penalties. And so you may have to entice the buyer, if loan assumption is really on the cards, you may have to entice the buyer to take on the loan. Again, they'll go through the very same exercise that I just shared. And at that point, it becomes a cost benefit analysis. Do you discount the price of the property to quote unquote entice them to take over the loan, or do you pay the prepayment penalty? And the answer is probably somewhere in between. Again, you always want to think about the investors in that case, and making sure you're taking the best decision for all parties involved. So anyway, it's a topic that I tend to get a lot of questions about, so I thought I would pop in briefly, share not only my thoughts but also key considerations for you to keep in mind as you're evaluating and underwriting investment opportunities with loan assumptions. And if you got a little bit of value from the content, I encourage you to subscribe to my YouTube channel and or follow me on LinkedIn and YouTube. This way you'll get notified of future live events, and you can find a ton of additional educational content on underwriting apartments, passive investing, due diligence, risk mitigation, and so much more. And that's all for today. I wish you a blessed day, and I will see you soon. Ciao.